A few private fixed income bonds do have a third-party credit rating, but the majority don't. Let's examine why. A credit rating is a measure of the creditworthiness of a borrower. The purpose is to guide investors in assessing credit risk. Credit ratings can be applied to companies as well as financial instruments. Naturally, the financial strength of the firm will impact the rating of any bond it issues. The three most famous credit ratings agencies are Standard & Poor's, Fitch, and Moody's, but there are many others across international markets. If a firm issuing a bond wants a credit rating, it must pay the fees of the credit ratings agency. According to the World Economic Forum, in 2022, the global listed bond market totaled $133 trillion. A listed bond is simply a bond that is available to trade on a recognized public stock exchange, such as London or New York. An exchange listing has numerous requirements that must be complied with by the issuing company. This gives investors confidence in the transparency and regulatory oversight governing bond trading. Aside from credit rating, there are other ways to assess risk, one being whether a bond is secured or unsecured. An unsecured bond means no specific asset is put up as collateral. Instead, the overall pool of assets of the corporation is used to back the bond. According to the National Bureau of Economic Research, more than 95% of listed bonds globally are unsecured. Corporations rely on the strength of their balance sheet and cash flow to back up their bond issuances. This explains why credit ratings are so important. Third-party specialists analyze the business and give an objective measure of the financial robustness of the corporation. In contrast, a secured bond means that specified assets, for example land or capital equipment, are offered as security collateral. In case of default, title to the assets is transferred to the bondholders. Secured listed bonds tend to be issued by companies that are smaller in size, or where issued bonds are rated as high yield, i.e. below investment grade. By giving investors the comfort of asset-backed security, the issuing company is more likely to achieve its borrowing needs. The advantage to investors is an attractive return on investment, combined with lower risk to capital. Similarly, in the case of private, unlisted fixed income bonds, if a bond issuance is secured, there is less requirement for a credit rating. When debt is secured by collateral assets, investors have more comfort in the security of their capital, as well as their legal recourse in the event of default. Nevertheless, every investor should be sure to understand details of the security being offered by a private fixed income bond. To find out more about investing in private fixed income bonds, make sure to download our free guide, available from the Fixed Income Genius website.